Welcome to the UTI Swatantra series powered by ET Now. I'm Faye D'Souza. Thank you so much for joining us. In our continued effort to help you understand investments and become rich over the long term, this week we're looking at how you can use mutual funds to achieve your life goals, whatever they may be. Now, if you have a question for us, you can reach us on our website, indiainvestkaro.com, or you can tweet out your question, #Swatantra. Joining me in the studio to answer questions this week are two wonderful gentlemen. S.G. Kolkur is an IFA, which is an independent financial advisor at Bhagyashree Investments. And Mehul Asher is the CEO of financialdoctor.co.in. Mehul, I'll start with you. Tell us simply how a mutual fund functions. So for the benefit of the audience in the studio and for those watching at home.
Okay, so what I would suggest is that, a mutual fund is something which is just like a vehicle, it's like a vehicle that you are actually getting into. So it has different asset classes, so it has different stops. You can say that it has got debt, it's got equity, it's got a mix, you can hybrid it. So you can actually compare it right from a pure savings bank, you normally put your money in savings account. So right from a savings account, you can actually compare that with a liquid fund, which can actually be taken out, put in at any given time in 1 day's redemption figures and stuff like that. You got fixed deposits. Here you got a similar kind of option where you have a FMP, which is actually a fixed maturity plan. You have a more or less simple horizon. You want to take a little more. So more or less is just like a vehicle which is pooling its money together. It's not just like a one person putting in. There's a lot of people putting in the money together. You have a fund manager who's actually managing the fund, and based on the theme of the fund. So there is an investment objective for each and every fund, and based on that fund, the investment can take place. So the investment cannot go beyond the particular fund, the objective of the fund.
Actually, the other question a lot of investors had was that of regulation. The fact that that we've had over the history of this country several confusing investments. And the thing about, like you said, about mutual funds is that it's extremely regulated. So when I give my money to a mutual fund, there is a very clear framework within which that fund will function and use my money. Take us through why regulations are so important in the mutual fund industry and what sort of role they serve.
See, regulations are important for development of the industry and to protect the investor interest basically, because we personally may feel the regulators are far ahead of their days, but they have seen the world economies collapsing, the many companies collapsing. They don't want that to happen in the mutual fund industry. So the basic object is to protect the investor interest only. That is why so many regulations are coming and therefore all investor interest only.
So when I put my money into a mutual fund, assume today I put 1,000 rupees in a mutual fund. How does what are the regulations that will keep that 1,000 rupees safe? See,
first the regulator says the investors, whatever he says, mandate is very, very important. If he says equity, that should be put in equity only. If it is a balance fund, it should be balance fund only. And if it is a debt fund, it should be debt fund. That is why SEBI started color coding initially. Then afterwards, now they say some people may not understand the color code. Now they bought a riskometer. So when you take the form, it is clearly showed at what risk level you are there. So you understand that your risk is so much, so that is why your gains are much. If your risk is less, you are going to get less. So that the public should understand. That is why the SEBI has made this way.
All right. So it's important to understand as investors that you're not just randomly giving your money to some company. There is a regulator that makes sure that there is a framework and that your money is safe. Mehul, tell us this. We're talking about creating life goals and achieving life goals through mutual funds. And you talked about the fact that there are funds that are aggressive equity right up till debt, which functions exactly like a fixed deposit. So if I'm looking at a life goal right now, that could be anything from wanting to buy a house in the next couple of years to my child going off to college in the next 20 years.
Absolutely.
How can a mutual fund or these different types of mutual funds serve all of these purposes?
There's a simple funda which always works, which is high risk, high return, low risk, low return. So as you're going to start reducing amount of, you say, okay, I want to be safe, I want to be safe, I want to be safe, you're not going to be moving in a faster vehicle, right? Now, do you say that, okay, is it risky, is it this thing? Now, what history has actually proven that even if you're in a pure equity fund, over a period of 3 to 5 years, those funds have not given you negative returns. So now, do you call them risky? No, I would not really call them. What I would actually call them is volatile. They're actually volatile. So that's the only problem with them. So what happens is that you will see them going up and down along with the market. If you have a longer time frame, there is absolutely no problem. in being in any of the slightly riskier asset class like an equity. Now, how would you do that? Like I said, the longer time frame, the more riskier you can go, because time is by your side, right? Now, as my goal is going to come closer, I need to move out from equity going towards debt, right? Now, again, if that also changes with the fact that what's your psychology. If you are the person who fears a lot, then you might as well not have a very high amount of equity. Maybe you can go for a balanced kind of a fund where you can, your asset allocation is very, very important. Now, what is an asset allocation? Is a mix of how much you're going to have a debt, how much you're going to have equity, how much you're going to have your gold, maybe your real estate. So, all the mix of that, there are different vehicles and what kind of allocation you're going to do. But primarily, I would divide them into two parts, equity and debt. And once you divided them, you more or less know how much to take your risk on. So, if the longer time frame you have, the more equity. The lesser time frame you have, the more debt.
All right. Do we have any questions from our audience members? Would anybody like to ask a question?
Who've just crossed 40 and have not yet bothered to invest on a retirement plan. I mean, how can mutual funds help us, and what would be a good time framework we should look at?
Actually, before you answer that question, do you have a PF deduction compulsorily going out of your salary every month?
Oh, I'm an entrepreneur.
You're an entrepreneur. All the more reason to look after your own retirement. So, because you're an entrepreneur, you can possibly work past the age of 60 as well. Do you have a plan in mind that you want to retire at 60 or 65 or 55? Is there a goal that you have in mind in terms of time?
Well, I would look at a regular retirement plan of say 60, 65, though I don't think I would live by it, but I would want to plan for it.
All right, so you still have a good 20 years. Do you want to take that question? What can she do in 20 years?
See, when you say you're 40 and next 20 years are with you, which is fairly long enough. Don't be afraid of the 10 years that you lost, but 20 years is too long. So at this phase, basically, you should, since you are an entrepreneur, you should try to go for a retirement fund. At least 3-4 AMCs you have got, whether you want debt oriented or equity oriented, you start with the retirement fund. Don't be miser in putting the money, put lump sums whenever you got, plus along with that you start an SIP. Okay? Because after 20 years, definitely whatever your expenses are today, you will minimum require 5 times than that. So you have to be ready for that date. So that is why SIP and lump sum investments in a retirement fund is very, very important. See, in life there are two stages. One is accumulation phase, one is withdrawal phase. Say next 20 years you go on accumulating. Supposing everything goes all right, and it will definitely go all right. So you have got about 5 crores corpus. From that 5 crores corpus, then you can tell the mutual fund you want this much monthly, quarterly or yearly. The beauty of this retirement fund of any mutual fund is in a FD, your original corpus never increases because you get the pension and whenever that. Whereas in the retirement fund or a pension fund of a mutual fund, what happens is you draw a very small amount monthly. The remaining amount is invested and it continues to be invested, and the NAV goes on. NAV means rate goes on increasing. So that is why one fine morning after 5 years, 10 years, whenever you want money also, that money is also more. So that is why you should be interested in a retirement fund. And for information, since you are not studied, I will say retirement fund is a balanced fund. Okay, balanced fund, the risk is less. What do they do is 65-35. Some funds will be 65% equity, 35% debt, and 35% debt or 65% equity. But fortunately, right now in India, whether it is debt oriented retirement fund or equity oriented fund, they are doing fantastically good as compared to any FD.
If I put in an X amount and I go by the ratio that the gentleman just suggested of a 60-40, what would be the end result, as in how many times would I expect my money to multiply?
In a simple answer, high risk, high return, low risk, low return, right? Now in a 60-40, now if you're going to ask me that what am I going to commit to you? The commitment is 0. All right? So you don't have any commitment. All right? It's going to give you the same returns, how your market is going to react, how your market plus the alpha that the fund manager will generate. All right? But at the end of the day, when you look at a past history, what has probably a Sensex done? I'm just looking at a Sensex pure Nifty product or a pure Sensex product. Your Sensex over the last 30 years has given a rolling returns or an average return of close to 16 to 18%. All right. Now, if my portfolio is mimicking, let's say, a Sensex portfolio or a Nifty portfolio, I don't see a reason why my fund should not perform in the same level.
Okay, we have to take a very quick break, but roughly what we've learned is that if you're looking at a retirement plan, these are the things that you should keep in mind. The lock-in, the charges, the equity allocation, and the tax treatment. When we come back, we'll talk about how to decide how much money to put in today for what I want at the end of my target. That's on the other side. Don't go anywhere. Welcome back. You're watching the UTI Swatantra series powered by ET Now. Thank you for staying with us. We're talking about how you can use mutual funds to achieve your life goals or your financial goals. Before we went into break, we talked about how to achieve your goal of retirement. But I understand we have far more questions from our audience members we'd like to work through. Yes, go ahead.
Yeah, my question is for Mr. Mehul. I'm a salaried employee. Definitely, even I think about investment once after 15 years when I don't have a job. So definitely these investments are the ones which would help me out. Now in context to mutual funds, the amount which I'm investing, even I would be using a calculator that after 15 years this is the amount that I might get. So is that amount fixed, that the percentage what we were talking about? It's like after 15 years I'm expecting 3 crores to come into my bank, and depending upon the market and the ups and downs, I might get 7 crores or I might get 1 crore. What is the difference?
Okay, so just to answer that question, right, like you said, I cannot tell you that this is what you're going to get, and that's what people fear the maximum, right? The fear is all about not knowing whether what will the exact amount that I'm going to get, right? Now I'll give you another perspective on equity. Okay, why equity as an asset class is better, all right? Let's say today, for example, you are investing, okay, in a particular company. Let's say you're working for a company. Your company today is growing at 30-40%, right? Tomorrow your boss comes and tells you that, okay, I'm giving you partnership in this company, all right? Now, if you know that this company is growing at 30% and you are a partner with that company, what is the amount that your money should be growing at?
30%.
Same amount? Yeah. Same 30%? So if that is the case, and now what's happening in an equity? In equity, the share that you're buying, what a fund is buying, the share, okay? Share is what? It's actually a partnership in that particular company. So if he's actually investing, if you are putting your money in that particular company, now here you put in a fund manager to identify which are the companies which are doing well. So they actually look at their balance sheets, they do their research, they probably check, you know, a lot of checks and balances that go into it, they have a research team over it, and then they identify stocks. Also, each fund has a mix of 25-30 stocks, maybe more, right? So the risk profile on a particular equity stock is small. Plus you are getting multiple diversification. So because of that, the probability of you making a negative return is lower. Now, as far as the figure is concerned, again, like I said, I cannot tell you a committed figure, but that's what you are getting scared for. But you look at the past history. Now, if the history of 30 years, now in the last 30 years, you would have had scams, you would have had wars, you would have had famines, you would have had floods, you would have had government changes, everything possible. But even then, if your Sensex has actually grown at 17-18%, and again, like I said, forget the Sensex, like I said, the companies that you're investing in are growing at 25-30%, then I don't see a reason why your money should not be growing at that level.
Justified, I do understand. But in that case, I need to do a research to which company is strong and it's like a pillar which would be doing well in the long run.
So that's exactly why you are appointing a fund manager. So when you're giving to a mutual fund, they have a fund manager, they have a fund management team, which is doing that for you, and that's what you're paying them the fees for.
Okay, then the obvious question is, then he has to do some research to find the right fund manager, choose the right mutual fund. Because in all fairness, there are hundreds of options available in the mutual fund market, and if an investor like him was to choose one, how does he choose a mutual fund? How should he choose the right one?
See, basically, mutual fund means all of us think that it is only equity. It is not like that. To start with, there are debt funds. Okay, debt funds, there is one fund known as liquid fund. We keep the money in the bank account, saving bank account. Why we keep? Because we are in a position to withdraw any time. And what the bank gives, 4%. Okay, some of such money you can put in a liquid fund. Okay, liquid fund investment can be done for 1 day also, 1 week also, 1 month also, 3 months also. This will give you 7 to 8%. all the liquid funds in India up till now have given 7 to 8%. So even if you get this much, your first hurdle or the fear of the mind will go, yes, this is the scheme wherein I got double than the bank. Okay. Then if you go a little longer, a short term debt fund is there up to 1 year if you are ready to keep. The short term debt fund of any mutual fund without this one, this will also give you more than the bank. Number 2, according to the tax angle, from the interest is taxable, whereas in a debt fund you have to pay at a lesser rate. Supposing if you want to keep in a debt fund 2 to 3 years, there are long term funds. Long term funds also, all long term funds have given at least 50% more than the bank. So without any hesitation, if you don't want to go for equity, you can go for a debt fund also. Then the second category is balance fund.
Okay.
Balance fund is, as we said, children funds are a balance fund, retirement funds are balance fund, and in fact, as the gentleman says, if you want monthly income, there are balance funds which are giving regular monthly income and quarterly income also with capital appreciation over a period of 5 to 10 years. So these schemes for monthly income, those who want, they are much better than any FD. Then come to equity. Equity, the first thing is equity. Don't be afraid of the equity, because equity, all said and done, in India also, over a period of 20 years, the mutual funds have given returns ranging in the range of 40 times to 80 times. 40 times to 80 times, this should clear all your doubts to say that I am going to get, my money is going to be safe, I am going to get tax-free returns and better than the bank. So it is for you to decide, depending upon your risk appetite, whether you go for a debt fund or a balance fund or an equity fund.
It's time for us to take a very quick break, but when we come back, more questions from our audience. Don't go anywhere. Welcome back. You're watching the UTI Swatantra series powered by ET Now. Thank you for staying with us. We're talking about using mutual funds to achieve our life goals. We have several questions that we'd like to answer. The gentleman on the left, go ahead.
What is better, LIC or mutual fund?
LIC or mutual fund?
It is not the question of saying which is better. Both are altogether different. If you want to have risk coverage, you should go to insurance company. If you want to have returns, you should go to the mutual funds. Trust wise, both are trustworthy. Absolutely, there is no problem. Okay? Because the only thing is, what we feel is, we say, well, I will take a LIC policy, I will get so much bonus and I will also get risk coverage. But the only thing what we forget is, by the time we get that money, the money value has gone down. Okay. So insurance you should keep separately and investment you should keep separately.
Mehul, if you can quickly tell us, there is a lot of confusion obviously between buying an insurance policy and buying a mutual fund investment. There is a very specific need for which we need to have life insurance. Tell us what that need is and why we should buy it.
Okay, so now first of all you need to understand as to each pocket is different, right? It's like saying that when you're traveling on the road, is cycle better or a car better or an aircraft better, but depends on where you want to go, right? So if you're looking at saying that, okay, I want to make sure that my family is safe, I am covered, tomorrow something happens to me, my family has enough money, all right, then you definitely need to have insurance. Now insurance, what do you need? You need that for cover, not for investment, right? So you first of all identify that each vehicle is different. You may use the same thing for two different things, that's a different thing, but that's not going to help you out. It's better to have specialists. So insurance is covering you, take a high cover so that by the time something happens to you, maybe after a few years, that amount is significant for your family and even then. Okay, again, how you're going to calculate that? Very simple. Take your current income, right, on an annualized basis, thumb rule basis, take it 10 times cover of your annual income. So that more or less will take care of something happens to you now. As your income keeps going up, you need to keep increasing your cover, right? That's the first part. Second part, your investments. Again, it's not mutual fund, it's not direct equity, it's not PMS, it's not, what is important is the asset underneath. So whether it's equity, whether it's debt, whether it's gold, right? You could have mutual funds which would have pure gold. And if the gold does not give you returns, it will not move anywhere. So what's important is the asset below it. So you need to identify whether you want to be in equity or debt or gold or anything else. There could be you could be into a real estate fund for all that you can. So there are various options available to you.
Is there anybody else who has a question? You have.
Every month we provide some ECS, like the sir has said us. That's like example 2,500 or 3,000 monthly we provide. So that's a better, or at a time we put like 3 lakhs or 2 lakhs in our budget's time. So which one is good? I'm asking for you.
Okay, you start with an SIP. That means out of every month that income that you're coming in, you set aside a fixed amount, and a fixed amount is getting saved on a regular basis. Whenever you have your bonuses coming, when you have extra money, when you say, okay, I don't want to, I have the extra funds, you can always top it up, right? So there is no, there's no particular way that you want to put it in, or you should. This is the best. This is the best. SIP works out to be the better option, especially in a more volatile kind of a fund, let's be an equity fund, because you are averaging your market on a regular basis. So what happens is something called a rupee cost averaging, which happens. All right. So when the market comes down, you're buying more number of units. When the market goes up, you're buying less number of units. So it's like saying that when you have a sale, you actually go and buy some more shirts.
See, for all the information of all the people, SIP and lump sum investment, these are not competitors. It's all depends upon how much you have. If you got lump sum lying in the bank 5 lakhs, definitely you search for the good person and put that lump sum. Plus, that means this accumulated money. Okay. What is SIP? Whatever you are earning every month, that is current income, out of that which you can save for tomorrow's expenditure. So that is SIP. Okay. So both are complementary to each other. They are not competitors. See, the basic purpose of going to mutual fund is risk diversification. Okay. Your money, if you give 100 rupees, it is compulsorily put across 20 companies, because SEBI does not allow more than 5% to be invested in one company. So that is why never be afraid of any companies going up or down, because the fund managers with their experience, they know if the company goes down, they will sell it and they will give. So that is why over a period of time, all these mutual funds, they give you better return.
All right, I want very quick closing comments from both of our guests. If there's a viewer at home today or somebody in our audience who's looking at a specific goal, a long-term goal perhaps, and is deciding how they want to invest right now, what advice would you give them?
See, as we said earlier, the allocation has to be debt and equity both. Okay. So for short-term goals of 3 to 5 years, you should go for debt funds like liquid fund, short-term fund or long-term fund. Okay. For the amount that you may require after 15 to 20 years, you can go for diversified equity, which will definitely give you inflation efficient and tax efficient returns. While investing, we have to remember only those things. When we are talking about LIC, because the returns came, but they are not inflation efficient. Okay. Here you are sure of getting inflation efficient and tax efficient returns.
What about you?
Okay, so basically what you need to understand is that what is your goals? You identify your goals first. Once you've identified your goals, then you know, okay, how much time do you have for that? And based on that timing and based on your risk appetite is what you decide. So today, if you are sitting on a lot of debt on your own self, a lot of loans, then you cannot go too much into equity. You know, if you are coming towards your goal close by, if your goal is coming in 3 years down the line, 4 years down the line, then you need to be more into debt. If you have longer period of time, yes, you can play the market cycles, then you should be more into equity, and that's the way you should actually balance your portfolio based on your age. As you are going to age up forward, your risk appetite is going to come lower.
All right, gentlemen, thank you so much for joining us on the show.
Thank you.
You've been a wonderful audience. Thank you for coming in. If you watching at home would like to join us in the studio at some point, you can log on to our website, indiainvestkaro.com, or you can tweet out your question to us, #Swatantra. Thank you so much for watching, and happy investing.
Brought to you by UTI Mutual Fund. हक एक बेहतर जिंदगी का.
Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.